Today, how complex is banking change really? Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today I'm joined again by John Dahlsen. Hello, John.
Morning, Martin.
Thank you very much for spending some time. Now, you've been busy looking at a whole bunch of things to do with banks, how banks should be reformed and changed, and I guess in the context of the current Senate inquiry into structural separation, that's a pretty important subject.
It's a very important subject, and it's a bit of a shame it's being overtaken by the budget and by the political shenanigans. And but I hope that in a few days' time, after we're through the budget, that it might get a bit of visibility because it deserves to. I think there's been a rather interesting couple of events that's happened in the last few days. One is the comment made by Graham Samuel at the Banker Summit run by the AFR, where he's talking about the not only the Directors Club, but now he's talking about a Women's Directors Club. Terry McCrann, I'm not sure if you're aware of it, but Terry McCrann picked that up quite strongly in the Herald Sun over the weekend, and he agrees with Samuel, and he adds a dimension to it in that he says that the women's club is partly created by the men's club. Now, I think these are very important observations, because what I've been trying to say with a different take on it is the incestuousness within banking, with the way people are moving from executive roles to directors' role, and how there's a limited gene pool operating with the banking sector. And I think that makes it worse than what Graham and Terry McCrann are alluding to. But it's very interesting that two very informed commentators are now putting that squarely in the public's eye. And I think that's good. And I think people have been skirting around that issue for some time. But the reason I think it's very important in relation to banking is because the dirty word, or the elephant in the room, is structure. And one of the reasons I don't think people want to address structure is because everyone's on about the status quo, and that comes about because of the limited gene pool for directors and the incestuous of the appointments within the banking sector. And it's extremely difficult to get any kind of outside influence of someone with some knowledge that can put a different point of view on the boards of these banks. And that's why the Senate inquiry is very important, because there are so many factors that are protecting the status quo. And I've addressed this in another way in some of my papers, where I've talked about the sameness of the banks, where you could change the name of a bank and you wouldn't know the difference. And I think this is the big thing is missing with Hayne, and I know that he was sort of asked not to look at that. And similarly, Murray squibbed it too, and he had the opportunity to do it. And his report was nothing more than a banker's report for bankers. So we've now missed two opportunities to address structure. The Productivity Commission had a go at it, but didn't go all the way, and I think could have been given a lot more information, because there's a number of approaches to this. Of course, we've got the Glass-Steagall, which has got some very important philosophy behind it. But I think in our situation in Australia, it's much, much deeper and wider than that, as to why we need to look at the demerging of the banks. And what I would like to see happen is a conversation. I'm not saying I'm right, but I'd like the smart people in the marketplace to have a look at it. I'd be delighted to debate it with any chairman or bank CEO. And it's great that they're having a Senate inquiry, but I don't think that inquiry is resourced enough to deal with the big issues. It really is a very big issue which cuts across a lot of things in our community. And I would doubt if that Senate inquiry will have enough information and enough help to produce a report that will resolve that. But nevertheless, it's good that it's happening, but I am somewhat cynical about its outcome. Now, look, there's another dimension to this, and that's what I call the imbalance of power between management and boards in banks. Now, when Graham Samuel had his inquiry on the CBA, I rang Graham. We were once sometimes competing, sometimes on the same side, so we know each other pretty well. And I wanted to speak to Graham to talk about this because over the years, I've had a lot of gossip about this from the other banks. Graham wouldn't take the call. He said, I want all submissions, whether they be oral and writing, to go through the minion. So I've got no idea whether he took it on board, but I do notice he is saying something about that now. And with that CBA situation, the thing they didn't deal with in that report was the huge imbalance between the power of management and the power of boards. And that's also a factor that's running here. I can't believe management would ever want to break up a bank. It's a sort of initiative that would have to come from a board, or it would have to come from an investment bank that does an analysis that goes into the market, that educates the analysts, who in turn go to the company and say, why aren't you considering it? And this imbalance between the power of boards and management also explains a lot that's happened with Hayne. And one of the problems about banking is that it is so damn complex, so difficult, and there's so much information. It is so easy for management, knowingly or unknowingly, to swamp a board with information, and it's extremely difficult in a bank to work out this month, next month, what's your priority. I mean, if you look at the situation at the moment, what's a bank board got to look at? It's got to look at the remediation. It's got to continually review its systems and everything flowing out of the Hayne thing. The banks have got massive competitive pressures from the Fintechs, from the high-techs. So for a board in the middle of all that complexity to sit down and say, I think we should have a good look at our bank model. But unfortunately, it's probably the most important thing that could be happening at the moment. And, what happens in banking is that CEOs start off with all the good intentions, but they become kingmakers. They become enormously powerful in the community, and they can make or break a lot of companies. And with some, that power goes to their heads. And sometimes they can be quite difficult for a board and a chairman to manage. Now, I don't think I'm telling any tales to say that David Murray was very difficult at Commonwealth Bank, and my information is that some directors found him extremely difficult, and a challenge was taken as an insult. And he's got a philosophy about boards, about being systems. If you don't like, think you call them the auditors, which is an extraordinarily narrow concept of what a board should do. So, in addition to the imbalance of power between boards and management, there's also a legitimate debate about what a board can do or should do in a very complex situation. Where you've got a company or a sector that's very simple, those issues tend not to come up because it's clear when board and management are working together. The issues are quite clear, so the boundaries aren't pushed like it is in banking, which tests your philosophy. And so I think that's another overriding complication. Now, the other complication I see in all this is what is a bank really all about? Well, I think a bank, there are four main issues. One, I think a bank, or the goodwill of a bank, is one, its understanding of risk. And what makes it different from everyone else? It's understanding of risk. Two is having the knowledge and skill and data and the people that can not only understand risk, but can execute appropriate policies. The third is their massive understanding of the consumer. And that's extraordinarily valuable information. And the fourth is having the infrastructure, including particularly technology, that can support all of that. And that is complicated by the fact that banks have got perhaps the most conflicted business model that you could ever envisage. There's a three-way conflict. First of all, they're looking after the interest of depositors. Second, they're looking after the interest of their customers. And third, they're looking after their own interests in terms of how much of the arbitrage should they take, and how much should they skim off the top or pay themselves, or however, like you say. So you've got that inherent conflict in the model itself, which doesn't exist in other sectors. So you've got all these, what should we call them, pressures on a bank that make it very difficult. But when you look at structure and when you look at what could happen by de-merging, you simplify a hell of a lot of those things. And that's why I say it's wider and deeper than Glass-Steagall. And there are so many, even if the economics were neutral, or even if they were slightly negative, I think there are powerful reasons why it's in the interests of the community to have a demerger. Because the complications that I've put out to you are not going to go away. And then overlaying that is another one. You've got Mr. Hayne. And fundamentally what Mr. Hayne is saying is, I want professionalism. Now, professionalism and trust is exceedingly difficult when you've got these three-way pressures, looking after the borrower, looking after the lender, and looking after yourself. And what's fundamentally happened is that we've had a massive regulation, and we'll continue to have massive regulation to deal with this. But until you have institutions that are based, are professional and are based on trust, you're never going to solve this. And you can take a simple example. Responsible lending. What does responsible lending really mean? What it means is, forget the prescription of what is in his report. What it really means is understanding and looking after the needs of customers. Of course you don't overload a customer with stuff that he can't pay. If you understood the structure, and the problem is the whole structure of banking has changed. It makes that more difficult. They're now sort of global, Australia-wide, mass-producing entities. So from every perspective, I look at this. I say structure is the answer. And it is so difficult to have this conversation. And I start to ask myself, have I got any, is there something I'm not seeing? And I say, please, Martin, please challenge me. Am I wrong?
Well, John, I don't think you are wrong, but I think that your point about the fact that large organisations want to get larger, and people feel that they want to grow, and the bigger they are, the better. Yeah, exactly right. So firstly, there's a self-perpetuation of a company for the sake of the company, right? But yes, that doesn't necessarily mean that the shareholder returns benefit from that, actually, because as you build complexity, you build inefficiency, you also quite often build poor performance, and there's a lack of focus on customer outcomes. And I think if Haynes says anything, it's about you've got to be thinking about customers, because actually it's all about delivering outcomes to customers. So, that's the first point. Second point is the technology up till about 10 years ago required scale, because the argument was we needed to get big to cover the costs of the technology platforms that we need. That is now bunkum, because effectively technology is cheap as chips. And in fact, you can actually develop, silos of technology to provide particular capabilities.
Exactly.
The third point is customers actually don't want everything under one roof. All the surveys that I go to say, I want a bit of choice, I don't want everything in one place. And yet we seem to be driving customers more and more towards, one or none, right?
Yes.
Because essentially, share of wallet, consolidation of data. And then the final point is open banking and the opportunity to be able to share customer data more broadly is a wonderful catalyst to be able to allow new players to come in and essentially offer new things to customers. So you can see there's customer benefit, right? There's shareholder benefit. There's benefit to the community also in more broadly because the economics of banking will actually improve, which means that margins can be actually compressed, which means there's more value created. The only losers are the empire builders inside these large organizations. And that's the sticking point.
Exactly. I think the interesting thing that you've said is scale. Once upon a time, the assumption is that scale means everything. Now, this is one of the problems facing the banks because they've got the high-tech companies with scale and dollars at the one end. And at the other end, they've got all these fintechs. And the fintechs, of course, are proving that you don't need scale. And in fact, scale is a disadvantage. And it's not that no one fintech is going to challenge the banks. But the difficulty for the banks is that in every sector of banking now, there are numerous fintechs. And the fintechs are all nibbling around the edges. And they are, the essence of what they're doing is they've got a simple line of product, a simple customer segment, and they've got a very streamlined business model, which will make them good profits. And what's interesting is that a lot of them are doing that. So I think this is another huge complication for the banks because scale no longer is an advantage because scale in banking terms is what you have said, and I perhaps shouldn't be repeating you, is synonymous with complexity. And what needs to happen, there needs to be simplification. And but the empire builders don't want it.
No, indeed.
How do we get a debate going?
Well, the DFA channel is helping, hopefully.
It's as you've said, again, I'm repeating you, it's in the interest of everyone for this debate to take place.
Yep. I agree,
What
John.
more can you say?
No, I think absolutely right. That's the absolutely point of this discussion is there is a critical imperative here that if we can actually get this to the right conclusion will benefit Australia, benefit Australians, and actually even benefit shareholders of the banks in the process. So it's a win-win-win. And the only thing that's in the way is the lack of political will and the survival of the large structures that sit over the banks and the self-protection of those structures, which to me are not the reasons to keep the status quo.
No. The other aspect of this, by the way, which I haven't alluded to, is the ACCC. Now, the ACCC is very concerned about the cartel behaviour of the banks, which, of course, arises out of the fact that they're an oligopoly. And that's a difficult subject because there's certain cartel behaviour by a bank, which is a good thing, like common banking platforms for everyone, which takes down cost. But the difficulty about it is where do you draw the line? And I'm sure that's agonising the Rod Sims. And that's another complexity that we haven't mentioned that is overlaying this, is the ACCC who don't like the oligopoly and believe that they've overstepped the line in terms of there being a public benefit for some of the common things that they do. So, however you cut the case, however you throw the dice, it just seems to lead down one track.
Mm. Yep. And it's worth making the point, John, that it's APRA actually who until quite recently said we want a small number of large players to benefit financial stability, right? So that's the sort of the countervailing argument. But of course, financial stability and scale may be easier for APRA to manage, but it doesn't necessarily, as we saw in the Royal Commission, lead to the good outcomes of customers. So I think that argument is also...
That's right. And that's right. And the other argument about all this too is that the massive regulation actually protects the banks. Yep. And all that APRA has done is reinforce the oligopoly and has had no sense of competition. And of course, unfortunately, that was one of the weaknesses in Haynes' report in relation to brokers. He didn't contemplate the effect of competition. The markets fixed that, and both sides of politics agree with that. So that's in effect been resolved.
Yep, indeed. Well, John, I really appreciate your time today. It's been a very interesting conversation, and I think that we've, again, given more evidence as to why banking separation should be considered, some of the critical factors that could actually be on the table, and I look forward to seeing what the outcome will be when they actually get round to looking at the submissions to the Senate, and hopefully we'll see some changes to the benefit of all Australians.
Hopefully.
John, appreciate your time. Thank you very much. So there you have it. I think a really important perspective from John. And once again, just to reiterate, your chance to have your say on this issue up till the 12th of this month. There are links below as to how to make a submission to the Senate inquiry into banking separation. And I do urge everybody to put a submission in and underscore the need to think differently about the way our banking system works. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.